Yo, what's going on, everyone? Welcome back to the channel. Jay here. In today's episode, I want to break down a popular dividend stock that recently reported earnings that impressed me, and that stock is McDonald's. Over the last 2 or 3 quarters, I've been kind of watching McDonald's, and they were trading extremely rich. But the recent earnings report has a lot of good stuff in it, so I'm going to break it down for you a little bit why I think they could be a potential buy in our dividends only portfolio. All right, check it out. All right, everybody, I just did a basic Google search for McDonald's earnings, and this little page pops up. Here's June 2023 right here. And year over year, revenue is up 13%. Net income is up 94%, which is extremely impressive. Their diluted earnings per share up 96% year over year. Net profit margin is up 71% year over year. So this tells me in the economy that the price of McDonald's goods are starting to come down. So those profit margins are starting to get back in line where they were the past few years before all this COVID craziness happened. And the operating margins up 18% is extremely impressive. This is not something I don't necessarily love is the cost of revenue is up 14%. That means this company is, spending a little bit more money to make the same amount of profits. But this is a great little layout because we can go to the other 4 quarters. So this was back in March, and these numbers are really good. Net change in cash, look at that, up 147%. They don't have it listed here. But these are all good numbers, revenue 4%. And the quarters, we got to remember, we're extrapolating this over a year. So 4% over a year would be around 12%. And then look at if we go back even farther, look, see how the margins are getting worse and worse and worse. And in September, they're even worse. So check it out. So when we go from, look at so we're inching up in December. The next quarter, we're getting better and better. And then June, they absolutely knocked it out of the park. And I'm really impressed by McDonald's ability to, deal with this current landscape, get their kind of supply chain in line, and optimize profits for shareholders and the overall business. So I want to check out Yahoo just did like a little expose. Some reporters talked about it. I want to see what they have to say about McDonald's and why this company continues to improve quarter after quarter and why their margins are getting better and better.
That it beat across the board in its Q2 earnings results Thursday before the market opened, in part thanks to that viral Grimace campaign boosting sales here in the US. Following the results, CEO Christopher Kempczinski and CFO Ian Borden spoke with investors to provide further insight on how the Golden Arches is performing in a, quote, more challenging macroeconomic environment. Yahoo Finance's Brooke De Palma is here with more. Hey, Brooke.
Good morning, Rochelle. That's right. We got some insight as to how exactly consumer sentiment is holding up into the second half of the year. Some top takeaways here include that consumers are, in fact, trading down. We're seeing that consumers are becoming more value conscious when they go and head for their Big Mac next time. And in addition to that, we're also seeing that sales are expected to moderate in the second half of this year as inflation and margin pressures are expected to continue. But we also did see some drivers here. A boost, as you noted earlier, came from that Grimace viral promotion. It only ran from June 12th to July 9th, but it drummed up 3 billion views on TikTok. And they said that viral phenomenon is yet another proof point of the power of marketing at McDonald's. In addition to that, we also saw some campaigns go viral overseas. They said Italian consumers were getting, get this, chicken tattoos or sandwich tattoos based upon their crispy McBacon, and also growth plans were also mentioned in the call. But diving back into that state of the U.S. consumer, CEO Chris Kempczinski did say that the U.S. consumer sentiment hasn't changed dramatically, but it's still far off from where it was back in 2019. He also said that value positioning is allowing the company to gain market share, but there has been slight changes in consumer behavior. Take a listen.
If you look at incomes under 100,000, we're actually doing quite well there, which suggests that we're getting some benefit from trade down, from things like full service dining, casual dining, et cetera. And then even if you go to incomes of 45K and less, our business is performing well there. What we're seeing with that group is we are seeing a little bit of a decrease in order size, but it's being offset by very strong or continued strength in traffic.
And Rochelle, value remains a key strategy for McDonald's as they look to that second half of the year as inflation continues to take a toll on consumers' wallets, but they do remain optimistic.
So what are they saying? Do they give more details about the rest of the year?
Yeah, well, right now they're confident in their strategy, which they dubbed Accelerating the Arches 2.0 growth plan. They think that they'll continue to gain share because of those strategies that they put in place. But CFO Ian Bourdain did say that he expects macro headwinds to continue this year. Take a listen to this.
But we recognize that we're operating in a challenging macro environment where costs remain elevated, customer discretionary spending is limited, and industry traffic is pressured. In line with industry trends, and as inflation begins to normalize later in the year, we expect top-line growth to moderate.
And he went on to say that inflationary margin pressures are expected to continue as well.
It's interesting stuff then. Also was taking a look at what we're seeing with these small store format cosmics that are supposed to be coming out, I guess in some limited form in some cities. We'll be keeping an eye on that as well. Brooke DePalma, thank you so much.
What can we take away from listening to McDonald's CEO and CFO on the overall business of McDonald's? I think what we first can take away from this is inflationary pressures are still hitting American households all across the country. Instead of going to your local restaurant around the corner to get some Italian or some Chinese, people are opting to go to McDonald's to feed their families because it's a lot cheaper, it's more affordable. If you've been to any local restaurants, like to get a Caesar salad in LA, it's like $20. When like at McDonald's, you could like feed a family of 3 or even 4 for $20. So we still see that inflation is a serious problem here in America. But for businesses like McDonald's, Burger King, Dollar General, Dollar Tree, they're seeing an increase in foot traffic because of the overall financial constraints on families. So even if their margins aren't as great of what they used to be, that overall traffic is still doing great things for the business. So that's why I think McDonald's is going to do well going forward because inflation is still super high. The Fed increased rates again because they really want to put a stamp to crush inflation, and hopefully over time, things aren't going to be so expensive. We can start going out to restaurants again and not so worried about pinching pennies for the overall families. And the CEO is saying, especially in that $45,000 range, these families are, buying less products, overall products, but they're continuing to go day after day to get their McDonald's and products like that because it's more affordable for them to like take their kids to McDonald's as opposed to taking them to a nice restaurant or even like a local Italian spot. So I think inflation is still here. American families are still feeling it, but I think companies like McDonald's are going to benefit. Real quick, guys, I just want to show you the EPS chart. And as you can see, they've beat overall consensus estimates for the last 4 quarters and really drove home the Q2 2023 earnings, really getting into serious profitability. $3.20 per share looks really awesome. And if you look quarter over quarter, we'll go down to their financials, and they continue to do around $6 billion in revenue and $2 billion in earnings, man. So $2 billion in earnings over 4 quarters. They're looking at around $10 billion in earnings for McDonald's. I think the overall health of the dividend is good. I do think it's still a little overpriced at that 30 PE ratio. I think the forward PE is around 27. But if we can buy McDonald's in that $250 to $260 range, I think it's going to be a buy. Let me know in the comments below if you like these type of breakdowns on these companies, and we'll catch you guys on the next video. Don't forget to subscribe. Peace.